Okay. Welcome everyone. We're gonna kick things off. So my name is Keith Miller. I'm an investor and a developer here in Missoula. So for those of you that's your first time, Missoula Real Estate Meetup has three main goals. We want to learn more about the Missoula market and the surrounding markets, share strategies and information, and make genuine connections. So a sponsorship opportunity is available for the meetup. I covered it for tonight. It's probably less expensive than you'd think. So let me know if you're interested in something like that moving forward. Our speaker tonight is Nicole. She works for an accounting firm, JCCS Services. She's a highly recommended CPA. Thank you, Ryan. Was that not on?
It's on. You're good.
She is a very highly recommended CPA by the group with a variety of real estate clients. She's going to discuss common issues investors see, covers some 1031 stuff in surface level detail, and answer questions. So other than that, I'm going to hand it over to you along with this. Thank you so much.
Okay, so this just pins on somewhere?
Yep.
Okay. All right, well, thank you all. Thank you for inviting me. And I've prepared a few things, but I just want you all to know I'm happy to answer any questions that might come up. Please feel free to, raise your hand, shout it out, whatever you need to do, because I'd love to make this time useful to you. I don't necessarily have an agenda. So when Keith and I were talking about topics, 1031 exchange is a big topic that people are interested in. It's very complicated and each situation is very detailed. So I'm happy to try to talk through as much as we can. But if we're getting into any details of your specific situation, just be sure that you really talk with your tax professional or a qualified intermediary yourself, or call me. We can have a separate meeting about it, but just don't take surface level 1031 advice and try to apply it to your transaction. So that's something that I just want to give the warning, because they are the type of thing that you can do 9 out of 10 things correct, and that one thing that isn't correct can really cause you heartache. So that's just a little disclaimer on 1031. And then the other thing in our discussions that we thought might be helpful is, where do people stumble, or what information are people often not aware of? And so I also, in the separate little handout here, included some information on the qualified business income deduction that's available for small business people in general, but also can apply to rental property. And so that's something that a lot of people are not aware of still, even though it's been around since 2018. So it's good to just review how you can qualify your properties for that, or if it's something that applies to your situation, just be aware of it. So why don't we start with 1031s? Who in here is familiar with what that means a little bit? If you can raise your hand. So pretty much everybody. Okay. So I'll just be very brief on the basics. 1031 exchange is a type of transaction that allows a real estate property owner to transition from one property they own into another one while deferring the gain that's associated with that sale. And so not paying tax on the transaction, ideally, until later on down the road. So it's a gain deferral mechanism. It's not a gain eliminator. So that's something that's really important. I think sometimes people think a 1031 exchange is going to take the eraser out and get rid of that gain, and it doesn't. It just kicks the can down the road. So it's really was dead for a while from 2008 until 2015. We barely saw any activity because real estate values were so declined. But now things are very different, and a lot of properties have a lot of gain appreciation over time, or if someone has held a property for a long time and used depreciation against rental income and brought their tax basis down, they could have a very low tax basis even if the property hasn't appreciated significantly. So there's some really important times to look at it. When you're looking at a sale, of one property or multiple properties that have a lot of that built-in gain, that's the right time to be thinking about 1031 exchange. And when you know you want to reinvest the money in a real estate type property, so whether it be rental property, land, and that can be commercial or residential. There's lots of different types of property that are considered like kind, even though they're not exactly the same. Of course, the IRS had to put some speed bumps around the transaction. So there's some pretty rigid guidelines that you have to follow. You basically have 180 days from the time you sell your relinquished property, which is the first property that's sold, to close on your replacement property. And that's a very important timeline. If you don't meet it, you will have a disqualified exchange and the gain will not be deferred. And within that 180 days, you have 45 days to identify properties that are potential to be that replacement property, and that's a very firm timeline too. So this information is in that 1031 exchange timeline too, so if you want it to refer back to later, you have it. And the most important person in the exchange is going to be your qualified intermediary person. That's the person who's going to receive all of the proceeds from your sale so that you never have money touch your hands or bank account, and it all is going through this third-party person. So they are the ones that are going to act on your behalf, because if you get any cash during the transaction, it will be a disqualified sale. So you want to, if you're interested in these things, we have great qualified intermediary providers around. I work with Catherine Whitmer a lot on many clients and others as well, but Catherine's just been very helpful to me. And so the information on your table is actually a printout from her website where she kind of goes through the basics. And she has a lot more detailed things if you're interested in that as well. But the qualified intermediary is really going to be the person in your team who is the most knowledgeable about all the details in a transaction and can really help guide you in the right direction. So finding that relationship and that person is really important. They have to be a part of the transaction, and they're really going to be the most knowledgeable to help guide you. So they're great. Let's see, what else is really important on 1031 exchanges that's very light.
Nicole, do you have to, if you sell a multifamily, do you have to buy a multifamily?
No, you have flexibility.
Buy a farm or a single family or something different?
Yep, you have a lot of flexibility on what is considered like-kind property. And from that, I would almost guide you to the internet because there's a lot of great information out there. But it's just basically has to be real estate of some type. So like-kind exchanges, they used to be available for business property, even for machinery, equipment, vehicles, things like that could be sold and the gain could be deferred. But a few years ago, that went away, and now it's just really for real estate investors and real estate type transactions. The other top question that I get is, can I do a 1031 exchange with my cabin to a beach house that I want to buy because I'm tired of the mountains and I'm ready to go to the beach? And you probably can't, because 1031 exchanges are only available for business property or investment type property, no personal use type property. And actually, personal use of replacement property can really cause you problems as well. There's a specific safe harbor timeline that so one strategy that comes up a lot is people sell a rental property and want to invest in the beach house that they'll use now that they're retired and have more time on their hands. And that can work as long as you follow some pretty clear guidelines of maintaining it as an investment property for enough time. And the safe harbor is 2 years. So there's a lot of possibilities, but you just got to really make sure you understand what your goals are, what you're trying to achieve, and what the road for you looks like to get that. So there's about a million different scenarios we could dive into. That's the highlights of the 1031 exchange. It's gain deferral, not elimination. You have to follow this pretty strict timeline, so be aware. And it's for business or investment property to business and investment property. So, yes, we have questions.
Oh, yeah.
Great.
45 days, you said you have to identify the property. And is that 45 days from signing, closing, or
From the sale of the relinquished property, which is what starts the clock on the transaction. So you can be looking ahead of time, and it's very wise to be kind of charting this out before you get to closing on your first property. The other question that's very sad that we get asked a lot is, oh, I just closed on my house and now I'd like to do a 1031 exchange, and it's too late. So if you have closed and the money didn't go to a qualified intermediary, it's too late. There's nothing you can do to backtrack into it.
Well, I was just going to follow up your question too. But you can identify multiple properties.
You can, and should, yes. Yeah, because you never know. I mean,
The 90 days once you, and there's another 90 days after that 45?
there's 45 to do the identifying, and then 180 to close. Yeah.
45 and after that 180? Or the whole thing?
They run concurrently. So you have 180 from start to close, from one close to the other close.
And the intermediary has to be informed before anything of a sale happens. Is that correct?
Yes, because when you go to closing at the title company, they need to send the proceeds to the qualified intermediary, who needs to hold on to them in their escrow account until you're ready to spend them on the replacement property. Yeah. So that qualified intermediary is very important. Yeah. Yes.
So, coming back to the personal versus business use, I mean, how exactly is that defined? Because the lines can get
It's
really
very
blurry
gray. Yes.
based on whether you're personally using it a certain amount of time per year, or how is that?
Yes.
Because a lot of people will hold even a vacation property in an LLC or something that is technically an investment and it's a business property. So how is that?
So personal use is defined very vaguely. It's a gray area. What you turn to get really into the details is case law. You know, what did people do and did they win in court? There is a small exemption. So if you were to do a 1031 exchange and you wanted to use a property personally within that 2-year period, you can use it a few days a year. I believe it's 10, but it could be 14, but it's very minimal. Otherwise, you can blow the transaction, and it's you or any of your family as defined by the IRS, or basically anyone, like even friends who come over to use a cabin. You know, it's going to be attributed back to your personal use unless they are paying customers and rent it from you. And my advice is that it is so tricky that usually people who are choosing a 1031 exchange are doing it because they have quite a bit of gain on the line, and they don't want to have a failed transaction and then have to pay the tax that's owed, especially 3 years later, when that tax was due 3 years ago, and now we've got penalties and interest that have been accruing. That it's probably better to be more conservative than more loose with it and preserve what you've put together. So I just really discourage personal use at all. Now, does that mean you can never go? No, you'll probably have work days. You'll probably have days that are pretty easy to document as you could use it and, you know, still enjoy a property. But if the purpose of your trip to be there was for work, then that can be a work day, and there's ways that you can deal with, you know, some use, but not necessarily that would be categorized as personal use and get you to where you're counting those days in that safe harbor period. Once you're out of the safe harbor period, it's a lot less scrutinized. So the IRS recognizes that just because you've committed to purchase a property through a 1031 exchange, that your whole rest of its ownership, you can't predict the future and what you might do or not do. I mean, people change use of property all the time. I don't know how many people have bought a home, lived in it as their principal residence, and then turned it into a rental, or vice versa. I mean, it happens sometimes within the same year. So that is certainly not a level that the IRS is going to hold you to just because you have committed to the 1031 exchange. So they've determined that that 2-year period is enough to prove intent and make it a valid transaction. Yeah.
One more question.
Yeah.
Is there, probably not, but is there a way to take some of your gain and use it for construction funding? Like if you buy a property that needs help,
There
you have
is.
it sitting there, can you use some of that?
You can, yes. You can even use it in construction of new property. So there is some flexibility there as well as far as what the replacement property can be. But again, the timeline is really important. So if you're going into a construction timeline, want to be very aware of that 180 days, because that construction and the money should be spent so that it can be closed and your gain can be deferred. So.
So I have to, okay, because last time I heard that was not possible, that is possible, that you use the money and from a sale of a property for constructing a new structure, and that can be tax deferred also?
And major renovations too.
Well, sweet.
Yeah, that's my understanding. And again, it's transaction by transaction, but there are some ways of looking at that. Yeah.
But that's it, may I ask, does that mean you cannot finish a house in 180 days? So-
Right. So you probably shouldn't be buying something that's just getting started.
Or use it for, I mean, let's say you sell one piece and want to build on another, and then, but you can't. I mean, you cannot get that house built in 180 days, so it would have, put it other way. Does it have to be finished and all spent?
So it's impractical. It's really impractical to start a project, especially, you get the money and then you get started. But you might find something that's partially finished that is a spec project or something else that you can get into at some point. So, and the other thing that's really important in the exchanges is how the relinquished property is titled, whether it's to a person. If I own it, then my replacement property must be what I own. So if I'm in a partnership, like me and my husband, we sell a property out of our LLC has to buy the new property. And that titling consistency is very important. So that can be a limitation for somewhat for investing too. And then also, if you're in a partnership that's going to have a sale and you'll have proceeds that you would like to use for a 1031 exchange, but none of your other partners do, or they're not going to be a part of this other project, that is very difficult to use a 1031 exchange for unless way ahead of time, maybe even best prior to contemplation of the sale, the partnership distributes the property to individual ownership, and then individual owners can decide what they want to do with their proceeds. But if it looks like it's in contemplation of the sale, it will be disallowed from the IRS for the transaction. So that is really important. And where I've seen that catch people a lot is where maybe husband owns a property, they go under contract for him to sell it. They picked out the replacement property and they want husband and wife to be on the title of the new property. That's not going to work for the 1031 exchange. He would have to take ownership, and then down the road, preferably after this safe harbor period is over, maybe look at transferring title. So.
In a situation like that, what's the look back time frame?
I think the safest thing is to think about 2 years. As far as retitling for the relinquished sale, I don't think there's a timeline there that matters. It's before the process gets going and you get into a sales contract.
Also, you were saying that
Oh, I wish I could tell you, oh, you're safe if it's 6 months or 3 months. It's not defined. The longer, the better. Yeah, again, and it depends on how much gain you're deferring as to maybe how much risk you're willing to deal with. The lower the gain, the less benefit of the deferral transaction, but maybe a little less risk than a very high gain. So, yeah.
So I have a question. So the taxes, so when you do this change, so the taxes from the house that you are selling, so those are calculated then of what you're going to pay down the line, or is it calculated down the line?
That's a really good question. Kind of both. The actual calculation for the exchange in the year that the transaction happens is reported with the realized gain. So the gain from the transaction gets calculated and determined, and then the next step is to determine how much of that gain is deferred. And that is, so not all 1031 exchanges are 100% deferral. Sometimes it's only a lesser amount than the total. So you calculate basically the tax attributes of that property and kind of lock them in. And then if it's all deferred to the future, those attributes attach to the new property. And it's kind of like you stepped from one's shoes into the new one's shoes, and you take all the attributes with you. So if the first property has had depreciation claimed on it, that depreciation will attach to the second property. And if it's eventually sold and the gain is recognized, you'll have all the attributes from the first property and then what happened during the second's ownership, and so you deal with that on the eventual sale. So sometimes when people are doing 1031 exchanges, many in a row, it can be a lot of tracking and record keeping.
It seems like you get trapped. Like you do this like 3 times in a row, you basically can't sell, right?
There are a lot of people who have low basis property who feel like they can't sell. They must die with it and pass it on to their heirs or to charity because it is just going to be too expensive tax-wise to sell. It's a bit of a thing to be aware of. Right now, you can get a little political around this for sure, but in our industry, most people think we have kind of record low tax rates. So that's another consideration when you're looking at 1031 exchanges, is not only can you predict what your future intent is, and are you going to be comfortable continuing to defer and to continue likely to step up in your value of your property's ownership? Because if you step down, you're not totally reinvesting the proceeds. That's where you can have a partial exchange and recognize some gain and defer some gain. So usually people who are really looking to defer step up in value for their replacement properties to make sure that they're reinvesting it all and deferring it all. But what if capital gains rates went from a high that we have now? The highest long-term capital gain rate anybody pays is 23.8%. What if that was 35% under a new political, regime? So who knows? If we had our crystal ball, we could do the math and figure it out exactly, but we don't live in that kind of world. And so unless you really are sure that it's a benefit to you, sometimes paying the tax now can be the right choice. So it's important to talk it through and really understand all of your options. Yeah. Any other questions? Yes.
Is there a ceiling amount in gain that can be rolled in?
Right now there is not, although it's being discussed. So there's potential that in the future there'll be a cap on the amount of gain that can be deferred, but right now, no.
Is your only option for resetting the basis, like you pass it on when you pass away?
Yeah. And that is even a potential to go away. So for everyone who didn't hear maybe, so how do you get rid of this built-in gain on these properties? Well, right now, under the estate and gift tax rules, we have what is called a step-up in basis that applies to all assets when someone dies and passes them on to their heirs. All their assets get revalued to the fair market value for their tax basis as of that person's date of death. So real estate, stocks, art, jewelry, collectibles, all of it gets revalued except for retirement plans. They're the ones that don't, but everything else. And that's whether you have a taxable estate or not. And remember, taxable estates are for those of us who have assets above about $14 million. So if you have less than that, then you're not going to have a estate that pays estate tax, but you're still going to benefit from this step up in basis, which is why for most people who have total assets under 14 million, the estate tax is actually a really positive thing for their families and their heirs and is a great tool. But as part of budget balancing, last summer it was being looked at very closely to eliminate that step up in basis. And when people in Congress are looking for options to increase revenue, anything can happen. I personally think that would be very detrimental. I think even a significant decline in that value would be pretty detrimental. The 14 million is set to sunset at the end of 2024 down to old values, which could take us back to $6 million per person. That's 2 if you're married, you get it times 2. But that is really the way, is to die and pass it on, or to gift it to charity. So if you give assets to charity, they will sell and recognize gain, but they don't pay tax on their gain because of their charitable status. So that is sometimes a choice people make as well. All right. Any more 1031 hot questions? Yes.
So, Nicole's my tax advisor.
Great.
I just did one of these. So I have this, I did rental for rental, and I had $100,000 for taxes. And it worked. And I did a reverse 1031 in 31 days. Now what do I do? What do I do with this rental property? What if I end up, after 2 years after Safe Harbor, I decide to live there?
Then that's fine. Then we would stop depreciating it and stop reporting income and expenses because use would have changed from rental purpose to personal use purpose. And so we just pause and keep all the records, and that's good for, and then your girls are fine, yeah.
Hey, but no, suppose I want to like reinvest, so I can't live there. What I'm doing is it's 2 weeks, and if you're living there doing maintenance or improvements, that's okay.
Yeah, work days are different than just personal use days, yeah, yeah.
But then I have to buy a more expensive or two more.
I mean, kind of just like Keith said, it can be a bit of a cycle because once you've deferred the gain, now you're continuing to build up gain. And if your new property has now increased in value more, yeah. Now, keep in mind, you don't have to do 100% deferral. So if you're willing to recognize some of the gain, you don't have to defer all of it. But you do have to be careful about use. So if you use it personally for a time period, you would want to make sure that you have it back as rental use before you were to go into a new exchange. Yeah. Here's another question I always get asked. Well, what if I just move into it, live it for 2 years, and then I get my personal residence exclusion of $250,000 of gain, or if I'm married, $500,000 of gain? And that used to work. on everything but the amount that was attributed to depreciation, so the actual appreciation of the property, that used to work. But about 2010, the law changed so that from that point forward, you would use a ratio of use to qualify for the gain exclusion. So if you owned it for 20 years and the last 2 were as your principal residence, then 2 over 20, 10% of the gain could be eligible to be excluded under that 250, 500,000. So if you have owned a property for a long time, the years before the law changed are grandfathered in, and so they don't count in the ratio against you. But as time has gone by, it's becoming more frequent that we see these properties where they're purchased after the deadline, or significant amount of time for the ratio goes by. So having it as your principal residence can help if that's something you plan to do, but it can't totally erase all the gain like it used to be able to do before. Yeah. Okay. All right. Any other questions on top of minds? Okay. So just real quick then, I'll, because we're already at 6:50, I'll just buzz through my other handout. So top page is best practices for record keeping, and you guys probably all love keeping your records as much as your accountant does. But I just always want to remind people and go back to basics that as a business person, your records are extremely important. They may not be the thing that you're most focused on day to day. There's a billion other things that draw your attention, but this is really important for your tax returns and for the management of your activities. So I highly recommend you take some time, if you haven't already, and invest in setting up a good system. It can be manual if that works for you. It can be a filing system. It can be a digital filing system. The IRS does not require that you keep paper receipts. You can take pictures, you can scan things, you can save PDFs from your email. All those digital documents are just fine. And a lot of times I'll recommend for small business people, and rentals will just put into that group, that you might even set up an email address that you use as a receipt deposit, where you take a picture and email it, because you probably don't need to spend a lot of time organizing it unless you're me, and then I just love doing that. But you need to have it if you ever come under audit and need to present the information. So if you have an email address you don't even log into and look at, you just forward receipts to, it's like throwing it in that filing cabinet, and it can be a handy way that's low threshold to do it digitally. And the other thing here is, if you're doing a lot of running around to properties, consider getting a mileage app to track those miles. There's some great ones out there. Mile IQ is one that a lot of people have success with, because the IRS is very strict on wanting to see contemporaneous written records to substantiate mileage. And it can be a pretty significant deduction. I think the rate is over 60 cents a mile these days. And so when you're running around doing stuff, you're looking for tax deductions, that's a good one if you can get those reports. So all those are very important. And I also throw in there that it's a good idea to have an Excel sheet or somewhere where you're tracking your work log, and that includes all your site visits, with some details here on the sheet, like hours of how long you were there for, what you did, when it was, and who performed the services. That's just good documentation, and it'll help you if you're trying to reach the threshold to qualify your rental as a trade or business that qualifies for the qualified business deduction. So who is familiar with QBI, or qualified business deduction? Couple hands. Great. So this came about in 2018. It was part of the Taxpayer Tax Cuts and Jobs Act in 2017. And you probably don't remember that detail, but you probably remember hearing about corporate tax rates going down to 20%. It was a huge drop. That was it, 20% for corporate. And that is a lot less than the highest individual rates, which ended up being 37%. So that doesn't seem fair for small business people who are individual reporters versus corporate reporters. So the mechanism that Congress put in to even the scales is that if you have a small business, and we'll see how you can qualify your rentals as this category, that income is eligible to have a 20% deduction that reduces the income by 20%, thus mirroring closer to that corporate tax rate. So it's designed to bring down the taxable income and then bring down the tax for small business people. And rental income by its nature, by the default, is that it's passive in nature. It's not active business income. So you have to do special things to make sure that it would qualify for something like this. And that's the second handout on the second page. There was a lot of discussion on, well, it is a gray area. What do you do? And finally, a year and a half later, we were able to get some clear guidance, and the IRS issued a safe harbor, which again, whenever there's a safe harbor, even in the 1031 exchange that we just talked about, that doesn't mean that your facts and circumstances, if they align just perfectly, might not qualify without meeting the safe harbor, but the threshold for your support and documentation and everything's going to be substantially higher, and it's just not something you can take as default like you can when you have a safe harbor. So to qualify rental activities under the safe harbor, there's at the bottom of that page, there's a couple key things, and it's that you keep separate books and records that are maintained to reflect income and expenses for each rental activity enterprise. So that could be one house, it could be a grouping of houses, it could be a multifamily unit. So you have to kind of assess your situation and see what your enterprise looks like. And if you, for that enterprise, have more than 250 hours of rental services performed by you or your agent, then it's likely that it would qualify for this deduction. And then you have to do your part too by maintaining those contemporaneous records to support that, like time logs, et cetera, that support that someone was there doing the work. Or it doesn't have to be there on site. It can be doing your accounting at home, doing your filing, making arrangements, but you just need to be documenting your work.
Does any of the renovation count, or does it have to be sandwiched in between rentals?
I think, so repairs and renovations, the hour rule really should be looked at per enterprise. So if you have one unit that's getting major repair renovation, I think we would likely classify that in the 250.
What about
Yeah.
if you just bought it and then you do the repairs, so it hasn't been rented first, you just go straight into renovation?
If it's your intention that it will be a rental, I think you probably would include that, because a lot of this law starts with your intention.
Okay.
Just like if you bought a house and you intend to live in it, that is where you are at until the day you decide, no, we're going to rent it. And how do you prove that? I mean, there's ways to do it, but the IRS has to kind of take you at your word, which is one reason why there's this safe harbor for 1031 exchanges, because so much rides on your intention, and they don't want to be arguing with people about whether or not they have a valid transaction if they held it for 6 months. I mean, something big would probably have to come up in your life that would change your intention, but prove, like maybe a death of a family member or something happens that you could not have anticipated and changed it. And so you might say, okay, well, I'm not the 2 years, but my situation is changing and I still feel like it's a valid transaction. So.
Does that work under partnership structures where just one of the partners is a real estate professional?
being a real estate professional doesn't necessarily automatically qualify you, but it's much more likely. And properties held in entities, likely partnerships, can qualify for the QBI.
Does it help to have a property in an LLC?
It doesn't really make a difference. It just matters who is, that you track based on the rental enterprise. Yeah. So I just think it's an important deduction that even a lot of tax preparers will miss, because it's another layer on top of gathering all the income and gathering all the expenses, making sure you're doing the depreciation correctly, making sure you're going through everything.